Total silence on the mainstream financial feeds this morning. It's January 14th, and I'm looking at my screen. Silver is sitting at $88.37, an all-time high. The headlines are screaming solar boom and green energy deficit. They want you to believe this is a clean, structural demand story. Industrial metals flying because we're running out of supply. Safe haven buying because the world is on fire. They're lying to you. I've been trading commodities for over a decade now, and I've seen this movie before. I use this AI avatar format purely for speed, to get information out to you faster than traditional methods allow, because in this market, 12 hours can be the difference between positioning correctly and becoming exit liquidity. And right now, we are exactly 24 hours post-peak. Yesterday morning, around 10:30 Eastern, the market hit a fever pitch. Silver spiked, everyone watched the ticker climb, and while you were watching that number go vertical, the CME group was behind the scenes effectively rewriting the rules of the game. Wall Street says the Iran intervention rumors are the catalyst. They say Trump's Greenland move is sparking a new Arctic gold rush. They want you to FOMO into the safe haven trade alongside a rising dollar. Buy now, ask questions later. The usual playbook. But here's what they're not telling you. The real story isn't about what's being bought. It's about who is being forced to sell. This isn't a demand story. This is a liquidation trap set by the House. And by the end of this video, you will see the hidden mechanism that just tripled the cost of holding a single silver contract, and why the so-called safe haven is actually a minefield. Let me be very clear about what I'm claiming here. Silver's climb to an all-time high is a positioning trap. It's being fueled by a historic shift in CME margin rules and a $3.8 billion passive selling dump from index rebalancing, not a surge in industrial demand. The conflict here is simple. The House, the CME, the dealers, the big banks, they're changing the rules mid-game to protect their own solvency. And retail investors, we're the exit liquidity. Today, I'm going to peel back the curtain on notional margin requirements. I'm going to run the math on why the numbers on your screen are a fantasy. And I'm going to share the 3 specific red line triggers that will determine exactly how I'm personally managing my physical and paper exposure in the next 48 hours. This isn't theory. This is what I'm doing with my own capital. And if you're holding silver right now, physical or paper, you need to understand what's actually happening before the trap springs shut. Let me give you the snapshot from yesterday morning. January 13th, 10:30 a.m. Eastern. Silver hit 88.37. An all-time high, as I said. Gold was sitting at $4,632.61. Lethargic by comparison. And here's the part that should make your antenna go up. The dollar index, the DXY, rallied to weekly highs at the same time. Stop and think about that for a second. Usually, a surging US dollar kills silver. They move inversely. When the dollar strengthens, commodities priced in dollars get more expensive for international buyers, and demand falls. The price drops. That's basic currency dynamics. So why are they rising together? The media narrative says geopolitical panic, flight to safety, everyone buying everything at once because the world is ending. The reality? This is a short squeeze, meeting a margin hike head-on. Let me show you something. Pull up the 30-minute chart from yesterday morning. Look at what happened right at the peak. There's a long wick rejection right around $89. That wasn't natural price discovery. That wasn't buyers and sellers finding equilibrium. That was a massive battle zone where the bid was completely exhausted. Someone or multiple someones tried to punch through 90 and the market said no, hard rejection. That's not what a healthy breakout looks like. Now here's where it gets interesting. While the paper price is hitting all-time highs, we're seeing $3.8 billion in index rebalancing. The big institutions, the ones who actually move markets, they're dumping paper contracts while the price is rising. Let that sink in. The price goes up, but the biggest players in the world are selling into it. This is the classic signature of a distribution phase. They are unloading their positions onto retail traders who see the price going vertical and think they're missing out. If demand is so incredibly high, if we're truly in a structural supply deficit, why are institutions dumping billions in contracts? To understand that, you have to understand the silent killer that's currently strangling traders who don't have deep pockets. I'm talking about notional margin requirements. This is the mechanism that's driving everything you're seeing on your screen, and most traders don't even know it exists. Let me break this down as simply as I can, because this is critical. Notional margin requirements are a relatively new way the exchange calculates how much cash you need to hold a futures position. Instead of a flat fee to hold a silver contract, let's say $15,000, regardless of where silver is trading, the exchange now charges you a percentage of the total trade value. If the price goes up, your cost to stay in the trade goes up automatically. Here's an analogy. Imagine you rent an apartment for $2,000 a month, and the security deposit is 20% of the building's total value. Seems reasonable, but then a tech billionaire buys the lot next door, and suddenly your building's assessed value triples overnight. Your landlord knocks on your door and demands an extra $40,000 in cash just for you to keep the same keys. You haven't done anything wrong. Your apartment is the same. Your lease terms are the same. But you're being evicted because you aren't rich enough to handle the appreciation someone else caused. That's exactly what's happening to silver traders right now. The CME switched to a 9% notional rate for silver. When silver was trading at $30 an ounce, that was manageable. Most traders could handle it. But at $88.37, the cash required to hold a single 5,000 ounce contract has effectively tripled. Small to mid-sized traders are being liquidated by the exchange itself, not because they made a bad trade, not because they got the direction wrong, because they don't have the capital to meet the new margin requirements that appeared out of nowhere when the price spiked. This isn't buying pressure you're seeing. This is a forced buy-in of short positions that are being blown out of the water by margin calls. The house just raised the stakes so high that only the banks can afford to play. And the math? The math is about to show you exactly why your safe silver position might not be so safe after all. Let's run the numbers on a standard COMEX 5,000 ounce silver contract. In the old world, when silver was trading around $30, the notional value of one contract was $150,000. The flat margin requirement was about $15,000. That gave you 10-to-1 leverage, risky, but standard for commodities futures. Now look at the new world. Silver at $90. Let's round up from where we are now because that's the psychological level everyone's watching. Notional value jumps to $450,000. Under the new 9% notional rule, your required margin is now $40,500. That's a $25,500 cash gap per contract. Let me make this real for you. If you're holding 10 contracts, not an insane position for someone who's been trading silver for a few years, you need to find $255,000 in cash by Monday morning just to keep your position open. $255,000. Most retail traders don't have that sitting in a sweep account. They don't have access to that kind of liquidity on short notice. So what happens? They're forced to sell. The buying we're seeing on the charts, that's shorts being covered because traders can't meet the margin. It's a vortex of forced buying that ends the exact moment the last small trader is wiped out. And when that happens, when there's no one left to force out, the buying pressure evaporates. The price collapses because there's no organic demand underneath it. Just a house of cards built on margin calls. And here's the kicker that nobody's talking about. The supply-demand fundamentals don't support this move. The 2026 deficit is projected to narrow to 140 million ounces. That's down from 230 million in 2025. The demand story is actually weakening while the price is exploding. The math doesn't work. When the math fails, the narrative is the only thing keeping the price up. But narratives are fragile. They break the moment people start asking questions. Now, I know what the bulls are saying. I can hear the counter-argument already, and it's a good one. So let me address it head on because I'm not here to sell you a one-sided story. The skeptic says, but what about the solar and EV structural deficit? Silver is an industrial metal, and we're running out of it. The $90 price is just reflecting reality. There's no metal left in the London vaults. This is a genuine supply crisis. Fair argument, let's test it. If we were truly out of physical metal, lease rates would be vertical. When there's no inventory available to lend, the cost to borrow skyrockets. But that's not what we're seeing. Lease rates are high, yes, elevated compared to historical norms. But they're stable, not parabolic. More importantly, mine production is forecast to explode in the second half of 2026. High prices solve high prices. That's the oldest rule in commodities. When silver hits $90, every marginal mine on the planet becomes economic. Supply floods back into the market. And let's talk about the Iran intervention narrative. Right now it's a rumor, speculation. If that rumor doesn't materialize into actual military action, the safe haven bid vanishes overnight. And what happens to all those traders who are already margin strangled? They have nowhere to go but down. Here's another thing that doesn't add up. Look at the CPI data that just came out. 2.7% headline inflation. Inflation is cooling. The Fed is winning the fight. Yet silver is acting like we're in a hyperinflationary spiral. The numbers don't match the reality. If this were a genuine inflation hedge, we'd see confirmation across other inflation-sensitive assets. We'd see gold running just as hard. We'd see commodities broadly in breakout mode. But we're not seeing that. Gold is barely moving. Crude is range-bound. This is isolated to silver, and that isolation tells me this is about positioning, not fundamentals. Let me recap where we are. We have a price at all-time highs. We have a dollar index rallying at the same time, which is unusual. We have a CME margin hike that's tripling the cost to hold contracts. And we have a weakening industrial deficit that doesn't support these price levels. This is a positioning squeeze, not a fundamental breakout. And positioning squeezes end violently. So what happens next? Let me give you the institutional reaction I'm expecting. If we touch $90, and I mean actually hold it, not just wick through it, the CME is going to hike margin percentages again. They want to de-risk the exchange. They don't care about your position or your profits. Their job is to protect the clearinghouse, and if that means liquidating every retail trader holding silver, that's exactly what they'll do. But there's a wild card. The DOJ investigation into Fed Chair Powell. This is the element that could change everything. If Powell is forced to resign, if this investigation escalates into something that genuinely threatens the Fed's independence, we could see a massive dovish pivot. That would be the only scenario where this silver rally actually has legs. A dovish Fed, rate cuts, currency debasement fears, that's the environment where metals genuinely run. But until that happens, until we have confirmation, I'm treating this as a positioning trap. Here's what I'm watching. 3 indicators, lease rates. If they spike from here, and I mean genuinely spike, not just drift higher, then the physical shortage narrative is real, and I'm wrong about this being purely a margin squeeze. The dollar index. If the DXY breaks below 102, the silver rally gets a second wind. A falling dollar is the one thing that could legitimately support these price levels. And the $90 resistance. This is the psychological wall of death. If we can't break through with conviction, with volume, this whole move reverses hard. Now let me tell you exactly what I'm doing with my own positions, because this is where theory meets reality. I'm not looking at the price anymore. I stopped caring about the number on the screen because the number lies. I'm looking at volume relative to that $90 resistance. That's the only thing that matters right now. Trigger A. If silver touches $90 tomorrow, or in the next trading session by the time you're watching this, and it does so on volume that is lower than yesterday's peak, I'm personally trimming my speculative physical exposure, not all of it. I'm not panic selling my stack, but I'm taking some profits off the table because I don't want to be the one holding the bag when the margin call flush begins. I've been through enough cycles to know that when volume diverges from price at a key resistance level, the move is exhausted. Trigger B. If the CME announces another margin percentage hike this week, I'm sitting on my hands. I will not add any new paper positions. I won't touch futures. I won't touch options. I'll wait until the forced liquidations are finished and the price tests the $83 support zone. That's where I'll reassess. If we hold 83 after a margin-driven sell-off, then maybe there's genuine buying underneath. But until I see that test, I'm assuming every move higher is artificial. Trigger C. If the dollar fails despite the Iran news, I'll reevaluate everything. A falling dollar in the face of geopolitical risk would mean this move is a legitimate currency flight. That would be bullish, for real. But until that happens, until the DXY gives me a reason to believe this isn't just a positioning squeeze, I'm treating this as a trap. My default assumption is that the house is pushing out the small players, and I'm not going to fight the house when they're changing the rules mid-game. Let me bring this all together, because if you take nothing else from this video, understand this. Silver at 88.37 is a margin-driven squeeze. The CME has tripled the cost of playing the game, and the industrial demand story that everyone's citing, it's actually cooling off. The deficit is narrowing. The fundamentals don't support $90 silver. The screen is lying to you because it only shows the price, not the rules. It doesn't show you the margin calls. It doesn't show you the $3.8 billion in index rebalancing. It doesn't show you the long wick rejection at 89 that tells you the bid is exhausted. Don't take the bait of a demand story when the math clearly says it is a margin squeeze. The biggest risk right now isn't missing out on higher prices. The biggest risk is being the last one in before the house pulls the rug. And they will pull the rug. They always do. Because this game isn't about making retail traders rich. It's about protecting the clearinghouse and ensuring the dealers don't blow up. I've been trading long enough to know that when everyone is talking about the same thing, when the narrative is this clean and obvious, you're probably already too late. The smart money positioned weeks ago. They're the ones selling to you right now while CNBC and Bloomberg tell you this is the trade of the decade. They're distributing into your FOMO. The Fed investigation is the key to what happens next. If Powell goes down, if the Fed's independence is genuinely threatened, that changes the entire game. That's when metals actually run for real fundamental reasons. But that's a binary outcome. Either it happens or it doesn't. And betting your account on a binary outcome is how you blow up. So here's my final thought. You need to understand the Powell DOJ probe to see how it affects your metals positions. That's the missing piece of this puzzle. The mainstream media is barely covering it because they don't understand how it connects to commodity markets. But it's the wild card that could either validate this silver move or expose it as the positioning trap I believe it is. Go watch our deep dive on the Federal Reserve's legal battle. That video will show you the rest of the puzzle, and you'll see why I'm positioned the way I am. This isn't financial advice. I'm not telling you what to do. I'm telling you what I'm doing and why I'm doing it. I'm sharing the data that Bloomberg terminals show me 12 hours before it hits CNBC. I'm giving you the institutional perspective that retail traders usually don't have access to. What you do with that information is up to you. But if you're holding silver right now, if you bought into this move thinking it's a clean demand story, I'm telling you to look at the margin requirements. Look at the volume, look at the index rebalancing. The signs are all there. The house is changing the rules, and when the house changes the rules, retail loses. That's not cynicism, that's history. I'll be watching those 3 triggers I mentioned. Lease rates, the dollar index, and that $90 resistance. If any of them confirm my thesis, I'll update you immediately. That's why I built this channel, to get real information out fast without the 48-hour delay that traditional financial media operates on. The landscape is cluttered with AI channels churning out garbage, but I'm here to give you actual analysis that you can use. Stay sharp, watch the data, not the narrative, and remember, the price on your screen is only half the story. The other half is written in margin calls and forced liquidations that you'll never see unless you know where to look. I'll see you in the next one.